Welcome to the Deep Dive, your shortcut to being instantly well-informed. It's Friday, August 15, 2025, and you can really feel this palpable tension in the global markets right now. It honestly feels a bit like a high-stakes chess match unfolding, doesn't it? Every move seems crucial for understanding where the economy might be heading.
It really does, and that's exactly what we're here to help you navigate. Think of today's deep dive as your, let's say, pre-market strategic briefing. We've done the digging through the latest economic data, the geopolitical whispers, all the corporate maneuvers to pull out the absolute key insights. Our goal, to cut through that noise, help you grasp the complex forces shaping these financial markets, so you're not just informed, but, strategically informed.
That's right. And the big picture today, it's just completely dominated by this surprise inflation shockwave. Came from the U.S. Producer Price Index, the PPI. This report, it just sort of blindsided everyone, didn't it? Threw a massive wrench into what looked like a pretty clear disinflation story.
A huge wrench, exactly. And what we're seeing today is, well, it's like a triple threat dictating where the market goes. You've got the immediate fallout from that PPI report, then critical consumer data hitting the wires this morning, and a really high-stakes geopolitical summit hanging over the weekend. Each one's a big piece of the puzzle.
Right. So what you're going to get from this deep dive isn't just what happened, but really why it matters for you and what to watch for as today unfolds. We're going to try and uncover some, frankly, surprising market divergences and maybe the logic underneath them, help you piece together this pretty dynamic and complex picture. Okay, so let's start with the biggest headline, really, of the week, yesterday's U.S. Producer Price Index report. After things being pretty quiet on the inflation front for months, what exactly made this report such a shockwave? Why should we be paying such close attention?
Well, it was a shock because it didn't just, surprise a little bit. It absolutely shattered expectations. The headline, PPI, it rose 0.9% just month over month. That completely dwarfed the consensus estimate, which was only 0.2%. And it marks the largest monthly jump we've seen since, June of 2022?
Wow, okay.
And yeah, looking year over year, it jumped to 3.3%. That's well above the 2.5% forecast people were looking for. Even core PPI, stripping out the volatile food and energy, told basically the same story. Also up 0.9% month over month, 3.3% year over year. This wasn't some kind of fluke.
Okay, so this wasn't just a blip then, or, a few odd items skewing the numbers. It sounds like something deeper is going on here.
You're spot on. It was broad-based. We saw a really significant, 3.8% jump in machinery and equipment wholesaling, for example. But maybe more importantly, what was also clear were rising trade services margins. Now, this strongly suggests that producers are successfully passing on costs, including potentially any new tariff-related costs right down the supply chain. And when producers can pass on costs that easily, well, it impacts everyone. Distributors, retailers, and eventually us, the consumers.
That makes total sense.
Yeah.
So how did the market, which was, really hoping for Fed rate cuts, how did it react to this inflation bombshell?
Oh, the ripple effect was immediate and pretty pronounced. U.S. Treasury yield shot up. The benchmark 10-year yield climbed quite noticeably from around 4.20% up into the 4.26%, 4.28% range. That tells you investors are demanding higher returns, bracing for maybe higher inflation, and a Fed that's, less likely to cut rates soon.
Right, so the rate cut hopes took a hit.
In a big hit, the market's expectation for a Fed rate cut in September dramatically repriced. And any talk of a larger, 50 basis point cut, that's 0.5%, that discussion just evaporated. It's off the table in the market's view now. What's really fascinating here, I think, is how this report just fundamentally alters the market's perception of the Fed. Before this, it felt like any economic weakness meant faster rate cuts were coming. Now, the Fed seems caught between signals of slowing growth on one side and accelerating inflation on the other. It really begs the question, which side of that inflation versus growth trade-off are we actually on right now?
That is the million-dollar question, isn't it? And what's really interesting is how this whole thing played out globally. Because while the U.S. was, grappling with this inflation surprise, not everyone reacted the same way. U.S. stock futures, they're cautiously higher this morning, trying to find some stability after Thursday's kind of mixed session. The S&P 500, it actually managed to squeak out a tiny gain to a new closing high yesterday. But the Dow and the NASDAQ, they finished down. And importantly, beneath the surface, the market breadth was really weak. Decliners outnumbered advancers on both the NYSE and NASDAQ by more than 2 to 1.
Yeah, that breadth is telling.
It means for every stock going up, 2 are actually falling. That signals some underlying vulnerability, even with the S&P at a high.
But contrast that with Europe. What's quite remarkable is the resilience we're seeing in European equity markets this morning. Frankfurt's DAX is up about 0.5%. Paris's CAC 40 up maybe 0.5 to 0.7%. Even London's FTSE 100, while kind of flat, is holding steady. And this positive mood in Europe, it's backed by a few things. German wholesale price growth actually slowed in July. That's a really stark contrast to the US PPI, right? Prices there actually fell 0.1% month over month. That brought the year-over-year growth down to 0.5% from 0.9% in June.
Wow. So they're seeing disinflation while we're seeing inflation picking back up. That's a huge divergence. It really is like two different economic stories playing out at the same time.
Right. Exactly. Plus, the Eurozone economy, it grew at a pretty decent 1.6% annualized rate in the first half of 2025. That gives them a fairly solid economic backdrop.
Mhm.
And, a softer US dollar also helps European exporters, makes their goods cheaper globally. So if we connect this to the bigger picture, what we saw overnight is just a really clear example of market decoupling. European markets seem to be trading more on their own positive fundamentals, their own decelerating inflation. It's allowing them to kind of shrug off the US data, at least for now. And this just reinforces that idea that, international diversification might offer a buffer against these very US-centric macro risks. It's a good argument for looking beyond just your home market.
Absolutely fascinating. So a real split between the U.S. and Europe. What about Asia? Was it a similar story of resilience there or something else entirely?
Asia was more of a mixed picture, really a story of divergence within the region itself. Tokyo's Nikkei 225, that was a standout performer. It rose somewhere between 0.9% and 1.7%. That rally was kicked off by stronger than expected Q2 GDP data, showed 0.3% growth, helped Japan dodge a technical recession, actually, despite all those U.S. tariff pressures. So definitely a bright spot.
Okay, a bright spot in Japan. But I'm guessing China wasn't quite so lucky. We keep hearing about their economic challenges.
Unfortunately, no. Chinese markets were definitely weaker. Hong Kong's Hang Seng Index fell pretty sharply, about 1.0%, that weakness, driven by disappointing July economic data, slower growth in things like retail sales, industrial production. Plus, you've still got the ongoing property slump hanging over them and the lingering impact of those U.S. tariffs. And, a slowdown in the world's second largest economy acts as a pretty significant headwind for global demand. We saw that reflected in the International Energy Agency's bearish oil outlook, which we should touch on. Elsewhere, Sydney's S&P SX 200 did close up 0.7%, but markets in India and South Korea were closed for national holidays today.
Got it. So a really mixed global picture. What does this all mean for today, Friday? It feels like all eyes are turning to the U.S. consumer and also this major geopolitical event that could really shake things up over the weekend. We've got a packed economic calendar this morning, mostly focused on the consumer. First up, July retail sales at 8:30 a.m. Eastern. Consensus is looking for a 0.6% increase. Then there's core retail sales that excludes the volatile auto sales, gives a better read on underlying demand. Consensus there is plus 0.3%. And then at 10:00 a.m. Eastern, we get the first look at the August University of Michigan Consumer Sentiment Survey. Crucially, the inflation expectations, parts of that Michigan report, those are going to be just as important as a headline number. The Fed watches those very, very closely.
That's exactly right. These consumer numbers, they're the crucial tiebreaker we sort of talked about earlier. If we get a strong consumer number today, well, unfortunately, that validates those inflation fears sparked by the PPI. And it would likely put more pressure on stocks, pushing those Fed rate cut hopes even further out. But conversely, a weak number, that would amplify the stagflation worries. That nasty mix of slowing growth and rising prices that creates a really difficult backdrop for risk assets, for stocks. So the data today isn't just about growth anymore. It's really about which side of that inflation versus growth tightrope the economy is currently walking on. It feels like a moment of truth for the market.
And if that wasn't enough uncertainty for one day, we have this significant geopolitical wild card hanging over the market, the Alaska summit. U.S. President Trump and Russian President Putin are set to meet at 3:03 p.m. Eastern to discuss the war in Ukraine. This feels like a truly binary risk event. I've heard traders are sort of squaring up positions, especially in things like crude oil, because of the risk of big price gaps when markets reopen Sunday night. And President Trump even warned of very severe consequences if there's no ceasefire agreed upon. That raises the stakes considerably.
It absolutely creates what traders call gapping risk for the Sunday open, meaning the price could open significantly higher or lower than Friday's close, depending on what comes out of that summit or doesn't. And equity markets, which seem really fixated on the economic data this morning, they might be, let's say, under-edged, meaning they haven't fully prepared or protected themselves for negative geopolitical surprise over the weekend. It's a classic situation where you have to think about what might happen when the markets are closed, when the lights are off, so to speak.
Yeah, absolutely. Okay, let's zoom out slightly and look at how these big macro forces are playing out in some other key markets, from oil to digital assets. First, in commodities, crude oil prices are looking pretty soft this morning, right? Hovering
Wow.
near two-month lows. What's driving that weakness?
It's really a combination of bearish factors weighing on oil. The International Energy Agency, the IEA, they actually cut their demand growth forecasts. They cited weaker industrial activity around the globe. In their monthly report, they even said oil market balances look ever more bloated. Basically, supply is expected to really outstrip demand heading into 2026. That's compounded by OPEC plus plans to start unwinding their production cuts later this year. And of course, the general pre-summit caution we just talked about. Traders are hesitant ahead of Alaska. So even with this high-stakes meeting, the sort of fundamental bearish supply-demand picture seems to be dominating right now. The summit would need to be really disruptive, I think, to significantly shift the focus in crude prices away from those fundamentals.
Yeah, makes sense. And what about gold, the traditional inflation hedge? Where does it stand in the middle of all this push and pull?
Gold's interesting. It's trading in a pretty tight range, around what, $3,357 an ounce? It's kind of caught in a tug of war. On one hand, that hot PPI data is technically bearish for gold. Why? Because it implies a more hawkish Fed, maybe higher interest rates, which makes non-yielding gold less attractive compared to bonds. But on the other hand, the underlying inflation itself, that provides a tailwind for gold's traditional role as an inflation hedge. People buy it when they're worried about rising prices. And interestingly, underlying demand seems pretty firm. Holdings in exchange-traded funds, or ETFs, are actually at a 2-year high. That suggests maybe a longer-term bullish story for gold is still intact, even with these short-term headwinds from the Fed outlook.
Right. Okay. Now let's talk about the crypto market because that saw a really dramatic reversal, didn't it? Bitcoin hit a new all-time high over $124,000 on Thursday. Incredible number. But then it sold off sharply, tumbled below $119,000, now trading around $120,090, down about 2.7% over the last 24 hours. What happened there? Was it something specific to crypto or tied to these broader market moves?
And that's the really key insight here, I think, the sell-off. It appears to have been directly triggered by that hot US PPI data. It sparked a broad risk-off move across markets generally. Anything seen as risky got sold, and it dampened those hopes for big, imminent Fed rate cuts. What's really crucial to understand is this downturn wasn't seemingly caused by internal crypto factors, no big hack, no regulatory news. It looks like a direct causal result of a macroeconomic data point. And that really showcases how cryptocurrencies are becoming more integrated into the broader macro landscape. They're increasingly sensitive to Fed policy expectations. They're not just, marching entirely to their own beat anymore.
Interesting. And I heard there's something else that maybe made the fall even worse, something about leverage.
Yes, exactly. The pullback was definitely exacerbated by a massive liquidation of leveraged long positions. Think of leveraged positions as bets made with borrowed money. So when the market turns against you quickly, those positions get forcefully closed out, liquidated to cover the losses. Over $1 billion in these leveraged positions got wiped out. And long positions, those were bets that prices would keep going up. They accounted for the vast majority, something like $866 million of those liquidations. So what this indicates is that the rally to new highs was probably fueled, at least in part, by excessive leverage, by borrowed money. And that makes the market really vulnerable to these sharp corrections when sentiment shifts suddenly. Ethereum traders specifically seem to have been hit particularly hard in this wave, with about $348.9 million in liquidations there.
Ouch. Okay, finally, let's touch on what's happening at the company level, because it sounds like a really bifurcated, sort of split picture out there in the pre-market action today. It seems like the market is rewarding strong past performance, but absolutely punishing any hint of future weakness, almost with extreme prejudice. Like, we saw Momentous Inc. surge over 71% on some warrant transaction news. D-Local Limited jumped 31% after a strong earnings beat. Even Intel rose nearly 4% on a report the U.S. government might take a stake to boost domestic chip manufacturing. Those are big positive moves.
Huge moves. But then you look at the flip side, and the market is just ruthless with any sign of bad news or caution. Coherent Core plunged almost 20% after it gave weak guidance alongside its earnings. Deere & Co. sank nearly 8% after it cut its full-year profit forecast, pointing to cautious customer sentiment. Farmers getting nervous, maybe? And Tapestry Inc., and they own Coach and Kate Spade tumbled 17% after warning that tariffs and import duties could shave about $160 million off its annual profit outlook. That's a direct tariff impact hitting the bottom line.
Yeah, it really showcases this significant negative asymmetry, doesn't it, in the current earnings season. While a lot of the Q2 results themselves have been pretty strong, looking back, the forward-looking guidance, the outlook, is turning decidedly negative. Companies are worried about inflation, tariffs, slowing demand. It's a tough environment to project confidence into.
Absolutely. Risk management is just paramount for investors right now. Any sign of future weakness is being treated, as you said, with extreme prejudice. We've also seen a few other earnings reports just before the bell today. And Cisco, often seen as a tech bellwether, it slipped about 1% after giving kind of cautious guidance as well. Even the analyst actions reflect this mood. You see some upgrades, sure, but also some pretty significant downgrades or cautious holds on names like Medtronic and Deere, reflecting those forward-looking concerns.
Okay, so to kind of wrap up our deep dive into today's market dynamics, it really is shaping up to be a true battleground session. You've got U.S. markets grappling with these fresh inflation fears, which could really force the Fed's hand. Meanwhile, Europe and Japan are showing some surprising resilience, dancing to their own beat almost. The consumer data hitting the wires this morning, that feels like the primary determinant for how the U.S. market moves today. But then you've got the Alaska summit looming as this significant kind of unquantifiable risk over the weekend.
Indeed. And the CBOE volatility index, the VIX, the market's fear gauge, it rose yesterday to 14.83. We'll definitely be watching for a sustained move above 15.00. That would signal a more notable increase in investor anxiety. Interestingly, the fear and greed index is currently still sitting at 63, which is technically in greed territory. Now, that suggests that despite the recent pullback, underlying sentiment hasn't fully shifted to outright fear, which potentially leaves more room for downside if today's data really disappoints.
So volatility feels like the baseline expectation for today. The market is searching, really searching for a clear narrative. Today's data will either seem to confirm those inflation fears sparked by the PPI or maybe provide a comforting counterpoint of consumer strength. This deep dive has really shown us that even in our interconnected world, different economies can absolutely dance with their own rhythm sometimes. So maybe the final thought for you is, what does this decoupling suggest about where you might find the next surprising pockets of strength, or perhaps vulnerability? Something to think about as you process today's headlines and try to navigate this complex chess match of the global markets.